This is Rick Rodriguez, retirement mortgage specialist with Fairway Independent Mortgage Corporation. Did you know that you can use a home equity conversion mortgage, also known as a reverse mortgage, to purchase a home? Not many people know that. And why would one do that? What would be the advantages? Well, today I'm going to cover exactly how you can use a home equity conversion mortgage to purchase a home while retaining more liquidity for your retirement. So let's get right into it here. I like to always start with an example. Can you spot the $466,427 difference in these identical homes? Well, I'll give you a hint. It's not going to be the roofing shingles or the special nails or the nickel-plated faucets or anything you can even see with the naked eye. The difference between these homes is that one of the buyers purchased with cash for $725,000, and the other utilized a home equity conversion mortgage in which they made a one-time payment of $466,427 and no monthly mortgage payments for as long as they live in the house. How could this potentially purchase power leverage help a homeowner looking to buy a home? Well, Cindy, 70 years old, selling her current home that's owned free and clear to move closer to her grandkids. This is her motivation, number one. And she would like to downsize when she moves and be able to set up an annuity for her grandkids to help pay for college. Cindy is looking to help her family today while she's alive and well and while she has the ability to help them. The community she lives in that she'd like to move to is more expensive than her current home, and a reverse mortgage can allow her to purchase a home in the new community and be able to have money left over from the sale of her home. So what does this look like for Cindy? Well, she lives in this current home of $400,000 that is away from her family, her grandkids, and she's looking to downsize into a home of $375,000. In this scenario, most buyers and even their real estate agents would probably be thinking that they would structure that $375,000 purchase as a cash purchase, right? Makes sense. You just sold your home, you walked away with $400,000, and you're in retirement. You don't want to have any mortgage payments, so therefore I'm going to pay all cash and put my entire $375,000 that I walked away with back into real estate. But with the home equity conversion mortgage for purchase at Cindy's age, she would just be required to make a one-time payment of $224,700. And instead of only having $25,000 left over if she would have paid cash, she will be able to have $175,000 left over. And that could be used for, of course, whatever she would like to use it for. In this case, again, her motivation was to help her grandkids pay for college. So Cindy was able to meet both objectives in purchasing the home that she desires, plus having money left over, in this case, to help her family. What about James and Mary, who are both 64, and they want to move to a newly constructed home to retire? They want to move to a new community. However, compared to where they currently live, home values are almost double. A realtor recommended to them that with a home equity conversion mortgage, they could afford to buy a new home in the community they want. So this is where they live right now. And if they were to sell their home, they would walk away with $373,600. Does this sound like you? A lot of James and Marys out there right now who have what appears to be a large amount of equity that they can walk away with. However, with where home prices are today, James and Mary don't feel that they can use that equity to buy anything that would suit their needs and buy anything that wouldn't require them to take out a traditional mortgage that's going to have high payments. So in many cases, James and Mary remain idle. They don't see how they could potentially make this happen until they learn about the home equity conversion mortgage. And they come to understand that at their age, the home equity conversion is going to provide them a mortgage that they can use to buy a home in which there is no monthly mortgage payments required. Of course, we always have to point out, as a homeowner, you still have to pay property taxes, homeowner's insurance, and maintenance fees of your home, such as an HOA due. But as far as a mortgage payment, no mortgage payment. So they could sell their home, walk away with $373,600. And if they wanted to maximize their purchase power with where interest rates are today, that could allow them to qualify for a new home up to $600,000 with their one-time payment of $373,600 and no more payments for life. So what is this H for P loan? Well, it was created back in 1989, insured by then President Ronald Reagan, who signed it into law. And it's been FHA insured for people 62 and older. It's an alternative to paying cash or taking out traditional financing in which you have payments for 15 years or 30 years. It requires a one-time down payment and no ongoing monthly mortgage payments for as long as you live in the home as your primary residence. It can dramatically increase a buyer's purchasing power, like we saw in the last example with James and Mary. So when you're purchasing a home and you're 62 and older, you now have three ways to pay for this home. You could pay for cash, you can take out a traditional loan with payments, or you can take out a home equity conversion mortgage for purchase. And in this example, this home worth $600,000, we're going to see how those three stack up against one another. So a traditional mortgage, 20% down is most minimum requirements. So 120,000 down, where interest rates are at the time of this video, approximately 7%. This would require a person to make a monthly mortgage payment, principal and interest only, of $3,193 per month over the next 30 years. For many, that doesn't seem very attractive to have that large of a payment in retirement and being required for the next 30 years, no matter what, to have to make a mortgage payment at the beginning of every month. That ends up being $1,149,642 that this individual would have to pay out of their pocket for the next 30 years. So as a result, what many people in retirement end up doing is paying cash for a home. For number one, the obvious reason that they don't want to have a mortgage payment that they have to worry about for the next 30 years, in some cases, the rest of their life. Plus, when they compare how much they're going to pay out of pocket on a cash purchase, which in this case would be $600,000, versus taking out a mortgage, it to them makes much more financial sense as well to do a cash purchase. This is why most people in retirement will do a cash purchase. We're learning today that there is a third option. If you are 62 and older, you can take out this home equity conversion mortgage for purchase loan, also known as an H for P loan, in which at this person's age, 62 years of age, they would make a one-time payment of $386,801. The home equity mortgage provides a loan at day one, which is $213,199, but there's no payments required. They're optional payments. So in this case, this individual is able to retain more liquidity, more cash for their retirement savings and not have the burden of being required to make a payment every month for perhaps the rest of their life. More security with the H for P. So what are the benefits of buying with this H for P loan? Well, here's a few things that it could help you with. If you're looking at a 55 plus community, an age restricted master plan community, this can certainly help one to get into the right community or the community that they desire. Increasing purchasing power. We learned about that here just a little bit ago, how you can take the cash that you walk away with from the sale of an existing home, and that could increase your purchasing power by allowing you to buy more home than just with cash alone, giving you much greater flexibility. Plus, the optional payment feature can give one more control over how they handle their mortgage. The no monthly mortgage payment, as I just spoke about, this flexibility and control can allow someone to have more liquidity and create more wealth for themselves. Naturally, when you have more control over money and you can decide where you want to put that money, that gives you the ability to further grow that. All sorts of reasons that people are using a reverse mortgage for purchase to buy a home. Moving closer to family, better weather, more appropriate home or location. Depending on one's age and current interest rates, the amount of the one-time payment can be anywhere from 40% to 70% of the purchase price of the home. And these numbers are not stagnant, these percentages that is, because it's determined also on interest rates. So as interest rates go up and down, this will dictate the percentages of the down payment. And lastly, these transactions are very simple to close, just as simple as a traditional mortgage. It does not have to take a long time. Of course, depending who you're working with and their experience with these products, these typically close in less than 30 days. And here at Fairway, we even have a fast track where we can close it, if necessary, in as little as 17 days. We'd say here, are you more interested in making memories over mortgage payments? Well, if you are, the H4P can be something that can help you free up cash to do more important things like investing in your retirement, or maybe some of the things that you've been meaning to do, hobbies that you've been meaning to get into that might require additional cash, that this H4P can allow you to get around to doing those things you've been meaning to do. Travel's a big one. In retirement, you've got extra time now, but do you have the extra cash to be able to travel to some of the places that you've been meaning to go to? All about making memories, right? And let's not forget the grandkids. If you have grandkids, we know how much you love to spoil them, spend time with them, and certainly that takes time as well as cash to be able to do so. So let's look at some of the problems and the solutions that the H4P loan can provide you. Well, one big problem that we see is we hear homeowners say, we just can't sell our home in this market for whatever reason, right? Or we need to take more out to purchase the new home for cash, right? So a big problem with trying to sell your current home and trying to get as much as you possibly can, or a certain amount, let's say, to buy that next home for cash. And sometimes with how the market might be, you can't hit the mark. So therefore you may decide to not go through with selling your home and purchasing the new one. Well, the solution with the H4P is that it gives you the ability to sell your home for the true market value, resulting in a quicker sale and still get everything you want in a new home, right? So because you're going to have so much more purchasing power on the buy side, that is your next home, this gives you a lot more flexibility on the sell side of your current home. You're not, in other words, restricted so much to a certain amount that you have to make from your current home to be able to buy the next home for cash, for example. So this gives you a lot more flexibility. What about you have to sell your existing home prior to purchasing that next home or your dream home? Well, with the H4P, It allows you to buy your next home for, again, on average, as little as 50% down, depending on your age, and eliminate the need for many to have an existing home sold or use other assets. So, in other words, because of the one-time down payment being 50% less in many cases than what you would have to use cash for to buy that same home, this gives people, again, more flexibility on how they make that one-time payment. Perhaps they have money in other sources aside from their existing home that they need to sell, where they can pull from in the interim, purchase the new home, and then they have time to sell their current home to move comfortably from one place to the other. And once they sell their current home, then they can replenish those other sources that they drew cash from to make the purchase. So again, giving one more options and more flexibility on how they sell and buy. What about big problem number 3? You can't get what you really want in your next home because of being on a limited income and not wanting to put all cash on the line, right? So, how could the H4P help? Well, as we're learning, with this loan, you can retain the majority of your cash and still live in the home of your dreams with all the options you want, right? Because you don't have to put 100% of your cash into the new property. This additional amount, once again, gives you additional flexibility and options on where you put your money. In other words, how you're going to retain it and where you're going to deposit that money that you're going to retain, as well as it can give you the ability to now maybe really create or design that new home with all the options that you desire, where you might have been a little bit more restricted if you were just using cash, and you might have held yourself back from really getting the right home or designing that right home the way that's going to best accommodate you. Shall we go a little bit deeper? How this program works? Let's do that. So it's all about leveraging your cash and increasing your purchasing power. As an example, right now, today, with where interest rates are at, someone who's age 62 has to put as their one-time and only payment approximately 65% down. And keep in mind, as interest rates come down, these percentages will also come down. So this is not a stagnant percentage that you're seeing here. This is ever moving depending on how interest rates fluctuate. The older you are, the more you qualify, is how this works. So someone who's 72 has to put a lower amount down, and someone who's 82 as well has to put a lower amount down. So as you can see, age plays a factor in how much you have to put down as your one and only payment for the H4P. I always like to break things down and make it a little bit easier to understand, shall we? So let's look at an example. Purchasing a home for $600,000, you're 72 years of age. With the H4P, again, qualification is based on your age, the purchase price, and the loan interest rate. Total cash out of pocket includes your down payment, the closing costs of buying a home, and the initial mortgage insurance of this product, which helps to protect the homeowner in a variety of ways. So if you took out a fixed rate reverse mortgage, H4P that is, on a $600,000 home, you would have to come with a one-time payment of approximately $364,200. That's the area in red. And the area in blue is the HECM loan that would be in place at day one, in which you have optional payment mortgage. If you took out the adjustable rate reverse mortgage, the amount that you have to put down is less, as you see in red, $327,600, and the amount that the loan provides is greater in blue, $272,400. So the equity position over time in the ARM example, which was the second, the adjustable rate mortgage, which is the more common option that's chosen today, as you can see over time, this is how your equity is going to hold up. So the light blue is the home value. The dark blue is the balance of the reverse mortgage, and the red is the equity. In this case, in this example, this individual purchased a home for $312,000, and you could see over time how these positions in home value, balance, and equity are going to change. So in 5 years from now, the value of the home would have increased. This is based on a 4% standard appreciation rate, which is a national average. The blue here is the reverse mortgage loan that's increased. And then the red is the equity. And as you can see, even though in this example, this individual has elected not to make any mortgage payments on their home equity conversion mortgage over time, 19 years from now, they still have $312,000 in home equity, which is their money. Okay, there's a big misconception that the bank owns the home or that the bank has the equity in the home, and that is false. This is just a mortgage lien against the property, period. You are the homeowner and you retain equity to the home. So in year 19, if you were to sell the home or your estate was to sell the home, which you can transfer title to your estate, they would walk away after paying off the reverse mortgage balance that's estimated at $319,000 with a home value estimated at $632,000. They would walk away with $312,000. So some things you should know about this H for P loan. Number one, minimal credit requirements. Something that we see with other mortgage products becoming a challenge for people in retirement is credit requirements are much more stringent. With the home equity conversion mortgage, there's no minimum FICO score, which most people did not know that. No minimum FICO score that's required to qualify for this H for P loan. Also, minimal income requirements. Again, with other traditional mortgages, this is the crutch that keeps people from being able to qualify because the income requirements are much stricter, and there's a mortgage payment that has to be factored in with traditional mortgages. But with the HECM loan, there is no mortgage payment that has to be factored in to the debt to income calculations, and the minimum requirement of income that the product wants to see is much lower than any other mortgage in America, making it much easier to qualify for the buyer. And of course, we already know that the big benefit of this product, the big luxury, is you are in control of your mortgage. There's no monthly mortgage payments that are required. They are optional, giving you the control of where you send your money every month, whether it's to a reverse mortgage account, to your savings account, or simply using the additional cash each month for other purposes and to help fund your retirement. Of course, don't forget, you got to continue paying property taxes, homeowners insurance, and maintenance dues with the home, such as HOA. So qualification rules. Again, this is for 62 years of age or older individuals. So the buyer or their spouse must be at least 62 or older to qualify. This H for P loan must be for a primary residence. It cannot be utilized at this time for an investment home or a second home. Must be your primary residence. The money that is brought to the closing must come from an asset account, such as an existing home that you sold or other investment accounts or bank accounts that are in your name, or it could also be a gift that you receive from someone. But it cannot be any funds that you acquire through debt, such as credit cards or other types of loans. What could disqualify someone from purchasing a home with an H4P? Well, unresolved federal tax liens. If you have any federal tax liens, because this is a federally insured mortgage, those federal liens would have to be resolved before we could close. Foreclosure or pending foreclosure, if there's any kind of short sale or a deed in lieu of foreclosure within the last 3 years, this could also keep someone from purchasing with an H4P. And if you have an existing FHA mortgage in your name, then that could also be a hurdle because you can only have one FHA mortgage on a primary residence at a time. Property types, well, virtually you can use this product for any type of property, single family residences, as well as 2 to 4 unit properties, some manufactured homes, modular homes, PUDs, planned unit developments, townhomes, and approved condominiums. Good to know right now that there is no maximum or minimum purchase price to utilize this product. However, the lender is allowed to provide you financing up to a purchase price of $1,149,825 starting on January 1st of 2024. That is the new limit that's going to be put in place here in the next few weeks. So what you are responsible for, that's important, right? Property taxes, as we've mentioned. Homeowners insurance and or homeowners association fees. General upkeep and maintenance of the home. This is for most common sense, things you're going to do anyway as a homeowner in making sure that the property doesn't fall apart, right? You're doing the routine maintenance, in other words. And with that, what else could this H4P do for you? The big picture in your retirement? Well, how about enjoying a more comfortable retirement, right? With an H4P loan, you'll own your new home and you don't have to pay back the borrowed money for as long as you live in your home and meet the loan terms. The loan terms being that you maintain primary residence in the home, you pay your property taxes, homeowners insurance and maintenance dues, and you continue to keep the property in good condition. So we ask you, would you rather make memories than mortgage payments? Well, if you do, then this would be something that you might want to look into. So reach out to me if you'd like to get more information on how the H4P loan can work for you. We can provide you with a personalized report and analysis so that you can see, based on your current situation, meaning the current home and equity that you have today, or the current amount of assets that you have today, how much you could qualify as your maximum purchase price with this product. And then from there, you could see, is this something that could get you in the home that you truly desire? Maybe a home that works better for you, as we talked about earlier, a variety of different reasons as to why people are moving in retirement, better location, closer to family, etc. What is that objective for you? Plus, how this could provide you with a more secure and liquid retirement by having more control over your money. How can you increase your existing savings with this product? These are all things that we review in the analysis, and I'm happy to go over this with you anytime. You've got my information. Reach out to me anytime. Hope you enjoyed this presentation on the H4P, and I look forward to talking to you soon.